Welcome back to the Daily Gold University. Thank you so much for joining me. Today is lesson number 7, the current valuations of gold and gold mining stocks. Let's get right into it. This chapter examines the current valuations for gold and gold mining companies. Gold is money and cannot be valued conventionally like a stock. We can only value it by comparing it to the other asset classes, stocks and government bonds, and financial data series such as a monetary base. We can compare gold to anything with a historical data set. We can assess where these relationships stand today quantitatively in comparison to previous gold market peaks like 2011 and 1980, and to previous gold market bottoms like 1929, 1970, and 2000. Gold, being at nominal all-time highs, may appear expensive today, but in real terms, that is far from the truth. Valuation data for gold mining companies is slightly elusive, but we can provide a rough history of conventional valuations, such as price to cash flow and price to net asset value, and how they compare to today's valuations. To begin with, let us compare gold to the stock market in the form of the S&P 500. Figure 7.1 plots gold against the S&P 500 and gold. The ratio is only slightly higher than it was around the lows at the end of 1970. The only other period in which the ratio was lower than today was during the stock market bubble of the late 1990s and its aftermath in the early 2000s. Hence, from a historical perspective, gold is quite inexpensive compared to stocks. Moreover, figure 7.1 shows that gold has yet to begin a secular bull market. When it does, it will outperform the S&P 500 as it did in the 1930s, 1970s, and 2000s. Side note, as of today, as we know, gold has broken out against the S&P 500 and has clearly began a secular bull market. We couldn't have said that a year ago or 18 months ago. Figure 7.2 plots gold, the gold price, against the gold price levels that would back a portion of the U.S. monetary base. The calculation accounts for the gold price, the monetary base, and the value of U.S. gold reserves based on the gold price. The amount of U.S. gold reserves has not changed since 1977. The gold price exceeded 100% backing multiple times during the Great Depression and again during gold's parabolic move and secular peak in 1980. Aside from the mid-1960s to early 1970s, the gold price backed at least 40% of the monetary base until around 1990. The 1913 Federal Reserve Act mandated that there would be 40% backing under the gold standard. Here are the important figures as of May 2024. A gold price of $22,000 an ounce would back 100% of the monetary base, and a price of $8,800 an ounce would back 40% of the monetary base. In February 2008, amid the global financial crisis, the gold price backed 29.7% of the monetary base, the highest backing since 1991. That backing today would require a gold price of $6,500 an ounce. Side note, these numbers are very similar as of today in April 2025. Figure 7.3 plots the percentage backing of the U.S. monetary base. As of April 2024, the gold price backs 10.4% of the U.S. monetary base. The percentage backing during the secular bull market of the 2000s increased from 10.9% to 29.7%. That pales in comparison to what transpired in the 1930s and 1970s. The percentage backing of the monetary base surged past 100% in the 1930s, 1940s, and again in 1980. Again, 100% backing today would require a gold price of $22,000 an ounce. The 1980 peak of 139% backing equates to a gold price of nearly $31,000 an ounce. We can debate how high the gold price could or should go, but there is a single unmistakable conclusion. Gold remains quite cheap historically. It is currently at one of the lowest levels ever relative to the stock market, but it is even cheaper than that considering the percentage backing of the monetary base. The conclusion remains the same when we assess the assets in gold against all capital market assets. Figure 7.4 plots the assets in all ETFs or all gold ETFs as a percentage of all ETF assets. A high reading would signal that gold is more popular as an investment, whereas a low reading would signal that gold is unpopular. The share of gold ETFs is barely above 1%, close to a 20-year low. The first gold ETF was introduced in November 2004. Although the price of gold has recovered and even doubled since the end of 2015, gold remains as unpopular today as it was then. Moreover, note how low the share is relative to the peak of 8% around the end of 2011. Side note, this has increased in recent months and is up to 2% as of today. That still remains extremely low historically. Gold's percentage of global financial assets is not as extreme, but below past historical peaks. At the end of 2023, the CPM Group estimated gold at 0.63% of global financial assets. This is less than 1/4 of the 1980 peak and roughly 1/8 the level of 1960. The figure grew from 0.15% to 0.72% during the last secular bull market and has not decreased much in the prior decade. The reason is likely the growth in emerging markets and the rest of the world's affinity for gold. Moreover, as we showed in Lesson 1, the price of gold is much higher, relatively speaking, outside the United States. Gold mining companies' valuations are historically cheap for two reasons. First, they have been in a secular bear market since 2011. Valuations were higher during the previous secular bull market. The second reason is the advent of exchange-traded funds, ETFs, for gold and silver, which made it much easier to buy and invest in gold directly. These ETFs financialize gold. Before the introduction of the first gold ETF, GLD, in 2004, gold mining companies traded at higher valuations because they were the easiest way to invest in gold. With the advent of gold and silver ETFs, investors no longer had to choose between gold miners' futures contracts or bullion. That removes a lot of buying of gold miners starting in the mid-2000s. Figure 7.6 plots the gold miners' price to net asset value over the past 40 years. The data is from Scotiabank. Since 2011, the valuation has remained below 1.5x and 1.3x for the vast majority. In a secular bull market, we expect the valuations to climb above 2. Figure 7.7, courtesy of Bank of America Global Research and Bloomberg, plots the price to net asset value valuation for several decades. It divides precious metals companies into 4 groups. Senior producers, the largest miners, are valued at around 1.5 times NAV. Between 1993 and 2008, their valuation reached 3.0 times NAV at a handful of points. The mid-tier producers are the cheapest in relative terms. They were valued at 2.0 to 3.0 times NAV in the 2000s, 2.0 times NAV at the 2016 peak, and close to 2.0 times NAV in 2019. They are valued now below 1.0 times NAV. Figure 7.8 also plots, also courtesy of Bank of America Global Research and Bloomberg, plots the enterprise value to EBITDA valuation. It is similar to the price to cash flow valuation. The image divides the companies into 4 groups and includes an average. The period is 2010 to autumn 2023, when mining companies have been in a secular bear market. The valuation for the average producer has ranged from 5x to 10x. It was nearly 10x at the end of 2010 and in the summer of 2020. It is currently between 7x and 8x. According to data from Bank of America and Bloomberg, the valuation hit 14x multiple times from 2008 to 2010. The juniors are currently valued above 8x. They have been valued at 12x to 13x a handful of times. Figure 7.9 is 2 images squeezed together. Both images plot the price to cash flow multiple for senior and mid-tier gold miners. The first image shows the valuation for each group from 1990 to 2013. The second image plots both groups' valuations from 2006 through June of 2022. The data is from different sources, so the charts are not aligned perfectly. The price to cash flow valuation peaked in the middle of the previous secular bull market, 2000 to 2011, which was around the introduction and adoption by investors of the first gold ETF. The peaks range from 25 times in senior miners to as high as 35 times cash flow for mid-tier miners. According to data from CIBC World Markets, the price to cash flow multiple for gold stocks reached 22 times in early 1975 and 1980, which were near peaks during the secular bull market of 1970 to 1980. The valuation of 6 times cash flow at the 2001, 2013, and 2015 lows was near the lowest in recorded history. In recent years, it fell to 7x and 8x, 7 and 8 times cash flow. At the gold stock low of October 2022, it fell to its lowest level since 2013 and 2015. Since 2012, the valuation has ranged from 6x to 16x, but mostly between 6x and 11x. At the 2016, 2019, and 2020 peaks, it reached 15x to 16x. Although the investment banks and Bloomberg have not recently provided a price-to-cash flow estimate for gold stocks, I found a workaround. Adam Hamilton, publisher of Zeal Intelligence, a great newsletter covering gold stocks, recently posted a table that included the quarterly cash flow of the top 25 companies in the GDX exchange-traded fund. After totaling the combined cash flow and market capitalization of the top 25 companies in the third quarter of 2024 and annualizing it, I calculated a price-to-cash flow multiple of 6.5 times, or 6.5x. Had GDX not recently declined by 15%, then the price-to-cash flow multiple would have been 7.7 times cash flow. By combining the various historical information, we can say that senior gold stocks have historically traded from as low as 6 times cash flow to as high as 25 times cash flow. Side note, right now, the gold stocks are trading at about 9 times cash flow. With the price-to-cash flow valuation historically low, it should be no surprise that gold stocks are very cheap relative to both the price of gold and the stock market. Figure 7.10 plots the Barron's Gold Mining Index against gold and the Barron's Gold Mining Index against the stock market. Note that 2015 marked a potential all-time low in gold stock valuations in terms of cash flow and net asset value. Furthermore, 2015 marked an all-time low in the value of gold stocks relative to the price of gold and the stock market. Relative to gold in the stock market, gold stocks have rebounded since 2015. However, they remain near all-time low levels against both, particularly against the stock market. Side note, that is changing and that has changed in recent months. Finally, figure 7.11 plots the share of ETF assets in gold stocks against the share of all ETF assets in equities. The current share is at a 17-year low, only months after a spectacular breakout move in the gold price. No other chart is more bullish for gold stocks. This chart shows that gold stocks are extremely underowned and have significant room to move once more capital moves into precious metals. Side note, that has started to happen in the last month and a half. Chapter summary. Although the price of gold has moved well beyond its 2011 highs and is trading at an all-time high, it remains extremely cheap relative to the stock market and monetary base. In addition, it is cheap considering its value relative to United States and global financial assets. Furthermore, gold ETFs account for a little more than 1% of all ETF assets compared to 8% at the end of 2011. Side note, that figure is 2% now. This information reflects that gold has barely started to emerge from the secular bear market from 2011 until late 2023. The gold mining sector traded at all-time low valuations in 2015 before gold bottomed at $1,040 an ounce. Although the gold price has more than doubled in the last 8 years, valuations for gold mining companies remain historically low and in bear market territory. Valuations have increased slightly since late 2022 when they were slightly above the 2015 lows. Moreover, the ETF assets in all gold stock funds relative to all equity ETF assets are at a 17-year low. This is shockingly bullish as it sets the stage for a secular bull market. That is the end of our lesson in this video. Thank you so much for tuning in. Next up is lesson number 8, where we will tell you all about gold mining stocks. Thank you for joining us.